Hello and welcome to the third installment of Know What You Own. This is a monthly webinar series where we take a deep dive into one of the positions recently held in your portfolio or one that we anticipate owning on the short-term horizon ahead. I'm your host, Eric Jefferson, and for today, we're going to focus on market neutral. Before we dive in, we have a few words just to keep the lawyers happy, and want to first start by defining what is market neutral. So this is a more sophisticated alternative type investment where strategy is designed to generate profit or a positive experience through both increasing and decreasing prices in different investments. That's defined by Investopedia. And so to really bring this to light, I want to share a hypothetical example. So let's say you expected over a time horizon of 6 months or a year that US stocks would outperform European stocks. Specifically, had the expectation that US stocks would return 7%, European stocks would decline by 3. So in that example, if you created a portfolio that was a 50-50 blend between those two positions, you would result in a positive 2% return. That's the average of +7 -3%. Now, if you had that expectation US stocks were to outperform, in all likelihood, you would then not own European stocks. And so, as outlined in option one, if you simply just bought US stocks over that time period, assuming your expectations came to fruition, you would earn a positive 7% return. However, if you incorporated both of these in a market neutral strategy, how that would look or how that would be designed is, in essence, you would own or go long US stocks, but you would hedge or you would actually receive the inverse performance of European stocks. To bring that example to light, your return stream in that scenario would be positive 7% from owning US stocks minus a negative 3% in Europe, minus a minus equals a positive. That would get you to 7 plus 3% equals a positive 10% return. Obviously, keep in mind, this is a hypothetical example, does not necessarily incorporate the impact of any fees or charges inherent in investing. Now, one of the benefits of market neutral is they not only offer multiple ways to generate profit, but they also reduce overall portfolio risk. Something in the choppy markets we're experiencing today is a very attractive feature. You see that was defined by AllianceBernstein earlier this year. So I want to go back to another hypothetical example. And again, let's say you expected US stocks to outperform European stocks. However, US stocks wound up being sharply negative, down 10% over whatever that time horizon was, and European stocks declined even further, down 15. So again, if we go through those three examples, if you had created a portfolio that was a 50-50 split between each of them over that time horizon, your portfolio would decline by 12.5%. As outlined in option one, again, with the expectation for US stocks to outperform European, if you simply just owned US stocks, your portfolio would be down negative 10%. However, if you created a market neutral strategy that was long US stocks and then hedged or received the inverse experience of European stocks, despite both indices being down double digits, you would actually achieve a positive 5% return. How we get there, again, you'd have a negative 10% return from being long or owning US stocks. However, you would then subtract a negative 15% return, again, with the understanding that you are hedging or you're receiving the opposite performance of European markets. A minus, again, gets you to a positive 5% return, despite double-digit volatility in broad indices. And so when we think of market neutral strategies, these can be designed with virtually an endless amount of combinations. You could own value versus growth with respect to region, owning domestic versus international as outlined in our example. You could do this with size, large caps versus small caps, or incorporating any number of factors. In this case, more of a conservative low beta versus a more aggressive high beta. So again, when we think about current environment that we're in, where markets are choppy, that ability to protect against broad market behavior or sell-offs is a very attractive feature that also allows us to try and generate excess return by owning specific segments of the market and capturing the spread or the excess return over those aspects of the market that are less attractive. Hopefully that makes sense. As always, happy to discuss in more detail. If you don't connect, have a great rest of the week. Take care.